Well, even though today's losses are somewhat mitigated like all the losses this year, our next guest says get used to it and make as much money as possible because Keith Springer is expecting the market to get really hit really hard real soon. Keith Springer is president of Springer Financial Advisors, and he joins us now. Keith, you're looking for a major crash right after the elections?
Well, down the road, you can't really time it exactly, Charles, but right now we've been given a gift. We have a QE3 or about to have a QE3. Luckily, the things in Europe are worse than they are here. We're still feeling the effects of QE2 in the positive, which is why economic data has been a little better than expected. And it was interesting that the Fed didn't wait for the economic numbers to get bad before announcing that interest rates were going to stay at zero for a couple more years, that they're going to start another QE3 program, asset buying, once inflation reached 2%, which would probably will. So we've been given a gift, and so the QE programs put a lot of money into this economy. It's going to buoy it up for a while, but eventually, you know, the free market system has to find its level roots.
And Keith, that's the conundrum, isn't it? A lot of people remember Alan Greenspan and his famous irrational and exuberant speech, but what people don't remember is that after he said that, we had a little bit of a pullback, and then we rallied for another 4 years. We were irrational for another 4 years. So how do you play this market? Because if someone gets out now and we keep going up, they're going to be upset.
That's exactly right, Charles. What you have to do is you have to do what I like to call the sweet spot. You have to invest for need, not for greed. Right now, there's plenty of opportunities in the lower risk. You basically find out what you need to do. For our clients, we get equity returns without equity risk. If you don't need all the risk of the market, you can still pick up great yields in corporate bonds, MLPs, preferreds, and have some appreciation on top of that. So you can get take much lower risk, but also get great returns. We're finding yields of 8, 9, 10% in some of these things without the risk of the market, and that's where investors really need to focus on. Of course, the really aggressive guys are going to want to play and day trade, but our clients don't do that. Most people just don't want to do that. They want to make reasonable returns. You can't keep money in the bank and earn nothing on it. It could be a while before a crash comes. There'll probably be a QE4. Yes,
right.
Shivani?
Keith, I want to jump in here because I want to press you on this call that we're going to see a market crash after the election, because you really are one of the first guests who has said that, at least in 2012. You say that liquidity and the QE, that we're seeing money being printed all over the world, is really the grease that's lighting this fire. But the Fed has not indicated that they're turning off the faucet anytime soon. So what is it that's going to be a catalyst for a potential market crash that you are predicting?
What's going to basically put the brakes on this is what's happened. The whole developed world is maturing and aging at the same time. We've got a demographic problem. People spend less as they get older. You're seeing it in Greece. More people are retiring, and it's going to happen here as well. It just happened there first. What happened is Greece hit about 160% of debt to GDP. Italy hit about 120 before the bond market stepped in. We just are now about at 100% of debt to GDP. Eventually, the bond market's going to say, hey, wait, hold on, guys. It's enough. You can't keep borrowing. We're not going to keep lending you money at these low interest rates. And interest rates are going to bump higher when they see the risk rise. I don't see it any time soon, meaning months or weeks, but it's possible. You wouldn't have thought in the last election, during an election year, the market would crash, but it did just about 4 or 5 months before Obama came in. So if...
But Keith, we've been winning.
Even though you're thinking about
Keith, we have been winning in this sort of risk-reward trade-off here. I mean, yes, we are taking on greater risk here in the United States, but it is much and far riskier in places like Europe right now, and that is one of the things that is helping to light this market. So are you making the assumption here that Europe is going to stabilize over the next 9 months, and then that, once we see a stabilization, is going to cause sort of the pullback in the markets?
Well, actually, I think I'll see a stabilization because Greece has no choice. I think we all know eventually Greece is going to default, but they really have no choice in the short term. They're going to have to sign the deal, which is going to help in the short term get Greece off the front page, allow the economic numbers here in America to look a little better than expected. Not phenomenal, but better than expected. The QE3, and there might even be a QE4 behind it as long as interest rates are low, floods the market with a lot of liquidity. So there's the ability to make money in this market, but again, you can't take all the risk. You know, you don't want to bet the farm that there's not going to be a crash. The idea is you can't sit in the bank. You've got to participate, but how? So do it in the least risky way you can, and that's why I like the high dividend paying stuff. The MLPs and the bonds, you can still get 8, 9, 10%. Right. That's really what it's after. That's what we're trying to do, Charles.
I got to tell you, Keith, it's hard to argue with you. By the way, like the haircut and love your candor. And I just hope that it's maybe a little bit further off than right after the election. Keith Springer.
We all do.
Springer
Good to see you again.
Financial
Thank you.
Advisors. Thanks a lot, buddy. Appreciate it.
Thank you.